Hi, Larry Gaines, Power Cycle Trading. In this video, I'm going to show you three earning cycle types of trades. Now, every new earnings season really presents the prepared trader three unique type of trade opportunities. So these are the type of trades that you can look for, and sometimes it can be on the same stock. So the first one would be a trend trade where we're looking for a specific stock. We use Netflix as an example to trend before its earnings release or announcement date, so to trend towards that date. So it could be a trend up or a trend down. The second type of trade is what I call the earnings release non-directional. So you don't know what the earnings are going to be, so you want to structure a trade that could take advantage of an explosive move up or down or no movement at all. And then the third trade is what we call the trend trade post-earnings. So a lot of times you'll see a stock after its earnings release will then establish a trend trade up or down, after the earnings. So let's take a look at how you can accomplish this. And the way I like to do the trend trades is usually by spreads. Now, why would you use spreads? Well, first off, spreads can move favorably in several different ways. So if you use a spread, you basically have 5 different ways to make a profit versus if you go long, you can only make money if it goes up. If you go short, only if it goes down. So for example, let's say we're long Netflix, short QQQ. So you could virtually or actually make money on Netflix if it goes up faster than the short QQQ. If Netflix goes up but the short QQQ goes sideways, you make money. If Netflix goes sideways and QQQ goes down faster, you make money. If Netflix declines more slowly and QQQ goes down a lot faster, you make money. Or you make money if Netflix goes up and QQQ goes down. So you make money 5 different ways. So let's take a look at a couple cycles on Netflix. So here's Netflix, the October weekly or October earnings were on the 16th of October. So that was on a Monday, and that's when Netflix was announcing its earnings. Okay, so what you're looking at is usually you go out 1 to 2 weeks before that and look to see if there's a trend starting to establish. So here would be going long Netflix, 100 shares. This is the way we would set this up, 100 shares long Netflix and 100 shares short QQQ, and then you use that ratio. You can do as many shares as you want, and we also do this using synthetic option structure. But let's say you went long here at, just to make it easy, $35. Okay, so you got long the spread, so your $35 Netflix was over QQQ per share. Now it went from 35, let's say, and you got out right here at that top, and that was 53. So 53 less 35, that's $18 per share increase times 100 shares. That's $1,800. Okay, so that's a pre-earnings trend trade up using a spread trade or a pairs trade. Now, look here, if you took the post-earnings trend trade, and let's say you got in here at, we'll call it 53, just to make it easy, and then it trends all the way down. Look at it start trending. That spread keeps going down, down, down. So here it reached a peak of Netflix about $53 per share over QQQ, and then it went down all the way to a low of around, we'll call it 30 just to make it easy. So then it was only $30 per share over QQQ. So that difference is $23, and that would be times 100 if you did 100 shares on each side, so that's $2,300. All right, so it's a really great way to do cycle trades, what we call pre-earnings trend trade up and then post-earnings down. So you can see here's the current cycle. If you'd gotten into this about 2 weeks or 3 weeks prior, you can see it started trending up, this spread, and it went from roughly 35 again right here to right here on the earnings released yesterday, got up to about 59. So that was about $24 per share. Netflix rose over QQQ or 2,400, and then on the earnings release we do a non-directional type of strategy, a couple different ones there. All right, I hope this helps, and I'll talk to you on the next video update.